The distribution rules for an inherited IRA can be a bit confusing. So in this video, we will break down inherited IRAs into two sections. During the first part of this video, I am going to focus on spouses, and in the second half of the video, I will focus on non-spouses. Now, as you may know, the required minimum distribution rules for an inherited IRA are different than the rules for retirees. So if you're here wanting more information about the distribution requirements for retirees, please watch this video instead. When it comes to taking distributions from a traditional IRA, a spouse has more flexibility than a non-spousal beneficiary. As a spouse, you have four options. Your first option is to take a lump sum distribution and pay taxes all at once. Your second option is to treat the IRA as your own, and it will be as if you have always owned the account. Your third option is to open an inherited IRA in your name and use the life expectancy method. And your final option is to open an inherited IRA in your name and use the 10-year method. You can treat the IRA as your own only if you are the sole beneficiary of your spouse's IRA. You can either designate yourself as the account owner by doing a spousal transfer, or you can roll over the account into your own IRA. If it's a taxable distribution, you can roll it over to a qualified employer plan, a 403A, a 403B, or a 457B plan. So within 60 days of receiving the distribution, you will deposit or transfer the funds from your spouse's IRA into your own IRA. You will not be required to take distributions until you reach your required distribution age. So if your spouse was older than you and you want to delay required distributions, then you should choose to treat the IRA as your own. And as a side note, most widowed spouses choose to treat the IRA as their own. Now, if your spouse was required to take a distribution before they died and they did not take it during the year of death, you will have to take the distribution that your spouse did not take. You cannot roll over this distribution into your IRA, and you will have to pay taxes on this distribution. The drawback to treating the IRA as your own is if you make withdrawals before you reach age 59 and a half, you will get a 10% early withdrawal tax penalty. So if you think you might need to take early withdrawals, you can roll over a portion of the funds into your own IRA and use an inherited IRA account for the portion that you might need to withdraw before you reach age 59 and a half. When you open an inherited IRA, you are classifying yourself as a beneficiary rather than treating your spouse's IRA as your own. If you choose to be classified as a beneficiary and choose the life expectancy method, you will transfer the funds from your spouse's IRA into a new inherited IRA held in your name. If your spouse died before their required distribution begin date, you can either start taking required distributions by December 31st of the year following the year of death of your spouse, or start taking distributions by December 31st of the year your spouse would have been required to start taking distributions. So the life expectancy method may be best if you are older than your deceased spouse and you want to delay required distributions. If you choose the life expectancy option and your spouse died after they had already reached the date that they were required to take minimum distributions, then you will begin taking an annual distribution over your life expectancy or over the remaining life expectancy of your spouse that was in effect at the time of their death, whichever is longer. In this case, you must begin taking distributions no later than December 31st of the year following the death of your spouse. If your spouse died before taking their required distribution during the year of death, you will have to take the distribution that your spouse did not take by December 31st of the year in which your spouse died. If you choose the 10-year option for the inherited IRA account that you set up, you must withdraw all of the funds by December 31st of the 10th year after the year in which your spouse died. You can take distributions at any time or wait until the last minute and take a lump sum distribution on December 31st of the deadline year. For instance, if your spouse died in 2023, if you prefer, you can wait until December 31st, 2033 and take one lump sum distribution at that time. If the IRA was left to more than one beneficiary, each beneficiary should establish their own account by December 31st, following the year of the death of your spouse. If the beneficiaries fail to set up separate accounts, distributions will be based on the oldest beneficiary. For instance, if the oldest beneficiary has to follow the 10-year rule, then all beneficiaries would have to follow the 10-year rule. Now let's look at your distribution options if you inherited a Roth IRA from your spouse. Just like a traditional IRA, you have the same four distribution options, but with slightly different rules. You can take a lump sum distribution, but if your spouse had the Roth account for less than 5 years, you will pay taxes on the earnings. Your second option is to treat the Roth IRA as your own and open up a new Roth IRA or roll it over into your own pre-existing Roth IRA. Your third option is to open an inherited Roth IRA in your name and use the life expectancy method. And your final option is to open an inherited Roth IRA in your name and use the 10-year method. You can treat a Roth IRA as your own only if you are the sole beneficiary of your spouse's IRA. If you treat the Roth IRA as your own and transfer the funds into your own existing or new Roth IRA, you can take tax-free distributions at any time as long as the original funds have been held for at least 5 years and you have reached the age of 59 and a half. If you haven't met these requirements when you take a distribution, the earnings will be taxable. You are not required to take minimum distributions on an inherited Roth IRA if you treat it as your own. If you open an inherited Roth IRA and use the life expectancy method, you will transfer the funds from your spouse's IRA into an inherited Roth IRA held in your name. You can either start taking required distributions by December 31st of the year following the year of the death of your spouse, or start taking distributions by December 31st of the year your spouse would have reached their required minimum distribution age. Distributions will be spread over your single life expectancy. As long as the 5-year holding period for the funds has been met, you will not be taxed on the earnings of the distributions. If you open an inherited Roth IRA and use the 10-year method, you will transfer the funds from your spouse's IRA into an inherited Roth IRA held in your name. You must withdraw all of the funds from the inherited Roth IRA account that you set up by December 31st of the 10th year after the year in which your spouse died. You can take distributions at any time or wait until the last minute and take a lump sum distribution on December 31st of the deadline year. As long as the 5-year holding period for the funds has been met, you won't be taxed on the earnings of the distributions. Now, let's talk about IRAs inherited by someone other than a spouse. Normally, a non-spouse has to follow the 10-year rule for an inherited IRA, but there are a few exceptions. The exceptions are if you are disabled or chronically ill, if the beneficiary is a minor child of the original owner, not a grandchild, or if you are not more than 10 years younger than the original IRA account owner. These beneficiaries don't have to withdraw all of the funds from the inherited IRA within 10 years. If you meet one of these exceptions, your distributions will be based on your life expectancy or the owner's life expectancy, whichever is longer. If the beneficiary is the minor child of the original account holder, required distributions will be calculated based on the child's age until the child reaches the age of majority. In some states, the age of majority is 18, but in other states, the age is 21. After the child reaches the age of majority, the remaining funds in the account must be withdrawn by the end of the 10th year after the child reaches the age of majority. If you do not meet one of these exceptions to the 10-year rule, the first thing that you should do is check to see if the original account owner was taking required minimum distributions. If the original owner was not required to take minimum distributions, then you can take a lump sum distribution and pay taxes on the amount. Or you can transfer the assets into an inherited IRA held in your name and empty the inherited IRA account within 10 years. You can take distributions at any time or wait until the last minute and take a lump sum distribution on December 31st of the deadline year. For instance, if the original owner died in 2023 and was not required to take distributions, you would not have to take annual distributions, but you would have to fully distribute the IRA by December 31st, 2033. Let's look at an example. Let's say that your dad died on July 7th, 2023 at the age of 57. Since your dad was only 57, he was not required to take distributions. Since your dad didn't have to take distributions, you don't have to take distributions. Just make sure that you empty the account by December 31st, 2033. In this situation, you are allowed but not required to take distributions prior to the deadline date. Now, if the original account owner was required to take distributions, you will also have to continue to take distributions each year during the 10-year period. The distributions will be based on your single life expectancy, and you have to withdraw all of the funds from your inherited IRA by December 31st of the 10th year after the original owner died. Also, if the original account holder did not take a distribution in the year of death and they were required to take a distribution, then you must take that distribution for them by December 31st of the year the original account holder died. For example, let's say that your friend passed away in 2023 at the age of 78, leaving you as the beneficiary of his IRA. He had been taking distributions since the age of 70 and a half. He took his final required minimum distribution in the year that he died. Since your friend took his distribution in the year of death, you don't have to take that final distribution. You do have to take annual required minimum distributions for the next 9 years based on your single life expectancy. You have to withdraw the remainder of the account by December 31st, 2033. Whenever you are required to take minimum distributions, you will have until December 31st of the year following the IRA account owner's death to begin taking withdrawals. Okay, so the rule is different if you inherit an IRA through a will, trust, estate, probate, or something along these lines. If you inherited an IRA in one of these ways, you will have only 5 years instead of 10 to distribute all the money in the inherited IRA account that you set up. When you set up your inherited IRA account, you have to be careful to set it up correctly. You will title the account in a special way so that you won't owe taxes on the lump sum. Please take a look at the example on your screen of how an inherited retirement account would be titled to avoid taxes when you move the funds from the original account to your account. If you put the account in your name without using the special wording, the entire balance will be treated as a distribution and you will owe taxes on the lump sum. You can't contribute new money to the inherited IRA account that you set up. This account will only be used to hold and distribute your inherited funds. If in any year you receive more than the required minimum distribution for that year, you won't receive credit toward the next year for the extra amount that you took out. Whenever you take distributions from your inherited IRA or take distributions from a Roth IRA that has been held less than 5 years, you will receive a 1099-R. You will report all distributions on your federal tax return. Please keep in mind that your distributions may increase your tax liability significantly, so you may need to pay estimated taxes during the year. Otherwise, you may owe penalties for underpayment of taxes. Most IRA custodians will automatically withhold 10% from your distributions unless you opt out of withholding by filing Form W-4P. One thing that you want to do is check with the administrator over the estate of the original IRA owner. If the estate had to pay federal estate taxes, you can take a deduction for any estate taxes paid on the IRA account. The bad news regarding the deduction for federal estate tax is that you won't be able to use the deduction unless you itemize. The good news is that although it's a miscellaneous itemized deduction, you don't have to meet the 2% threshold like other miscellaneous itemized deductions. I would like to let you know that you should always take your required distributions. If you don't, a 25% tax penalty will be applied to every dollar that you don't withdraw. If you forget to take your distribution but you fix the mistake within 2 years, the penalty will be 10% instead. If you don't take your required distribution, you will have to file Form 5329 with your federal tax return in the year in which you did not take your distribution. The penalty may be waived if you can prove that you made a reasonable mistake and that you have taken or you are taking reasonable steps to fix the shortfall. So if you believe that you made a reasonable mistake or had an unusual situation, you will write a letter of explanation requesting a waiver of the penalty. If you want to avoid increasing your taxable income due to required distributions and you are at least 70 and a half years of age, you can transfer up to $100,000 from an IRA directly to a qualified charity to satisfy your distribution requirement. You won't be able to take a federal deduction on the contribution, but you won't have to include the distribution in your income. If you're interested in making a qualified charitable distribution, please watch the video on your screen. It will give you more information on how to do it. I really do appreciate you spending time with me today, but what we just covered was not official tax advice or legal advice. Please consult with your tax advisor for personalized planning. I may not be able to give you official advice, but feel free to ask me a question in the comments section. All the best to you. Until next time.